Joining us this morning at Post 9 for the first time in a while is former PIMCO chief economist Paul McCulley, now an adjunct professor at Georgetown. Welcome back, Paul.
Good to be here.
So, progress, how do you characterize it?
Yes, I would call it fully benign after effectively the slap around the head in the first 3 months. And I think the market is rationally exuberant on the whole issue. Doesn't mean the Fed's going to ease anytime soon, but it's consistent with the whole notion that the next move is unambiguously an ease, and that's what a forward-looking market should be discounting, is the next move. And there was talk about the notion, could there be tightening again? And Jay Powell effectively just kiboshed that thing
Even as
yesterday.
recently as yesterday, right?
Exactly.
How many of these would you need to string together to get the confidence that Powell wants?
Probably need 3. I mean, we had 3 slaps against the head, so therefore just symmetry would say 3. And I say that in some respects tongue-in-cheek because it's a matter of confidence. And we didn't see OER crack today. And I think if you got OER to crack, that would reinforce the proposition. They can start talking about when they're going to do it. The big issue, he said, the direction is down.
But we are, to your point, still waiting for shelter to start to really come down, whether it's rents or OER, as you say, owner equivalent rents as well.
Yeah, we are, and I think the entire community, both on Wall Street, at the Fed, and everywhere else, is scratching their head on how long is this going to take. In fact, Chair Powell mentioned it yesterday. You know the new lease is coming in, and it's just a matter of how long is that lag. In fact, there's something to be said for we're dealing with the last lag as opposed to the last mile.
Well, what do we know then? If everybody's scratching their heads about it, have we learned anything in terms of when it's finally going to crack?
Hopefully we've learned some humility. Hopefully we've learned some humility. And I think Chair Powell would say amen to that. Because you know the piece parts, but trying to figure out exactly when it gets there is really difficult.
Meantime, Goldman's got a piece out today about residual seasonality in core. They do think there are some categories in CPI, PPI, feed into PCE. We might get some payback on the downside in the back half. Does that make sense to you?
Yeah, I have no quarrel with that. It's reasonable if you're going to do really bottom up and looking at the seasonals. And I think that's important for real time in the market. But at the broader picture, it's the Fed had huge success in getting inflation down to where it is. It wants to get signs that we're going to take another leg lower, and that's not going to be based upon, micro of residuals on seasonals and so forth. And so basically, I think the Fed's in a good place.
When you look at targets on the 10-year yield, which ones do you sort of say, all right, that makes sense, and which ones do you look askew at?
I'm looking at 4.5. I think it's going to be hard to stay below 4. Whereas on the other side at 4.5, then I think that you're in the value zone. So I'm looking at those as the broad range. And how I come to that is that I think that R star has gone up over time. And I would look at nominal R star as 3.5 to 4%. Throw on a term premium, and it gets you to 4.5 for the 10-year. It's not terribly complicated.
And so when do you see the first cut coming?
After Mr. Powell gets confidence.
So you're not going to give me, is it September? Is it later in the year? Are we still potentially pushing it out until 2025?
I think it could go out to 25, but I think the Fed would like to back off as soon as they get enough data that they can do it in a credible sort of way. So it's not going to be before September. Unambiguously, it won't be before September unless we get something unexpected. Or it could be December. So I think we're still live this year. And I think the marketplace is priced that, after, reversing the big discounting they had earlier in the year. But really it is data dependent and forecasting the confidence of 19 people sitting around an FOMC table.